It's that time of year again, and right now, thousands of Australians are about to lodge their tax return and leave hundreds, maybe even thousands of dollars sitting on the table. The ATO isn't going to call you up and say, hey, you forgot to claim that. No, they'll take every dollar you don't fight for. So the question is, are you actually getting back everything you're entitled to? Tax time in Australia doesn't have to feel like a guessing game. Every year, millions of Australians lodge their returns without a real strategy, and every year, millions of Australians walk away with smaller refunds than they deserve. Not because the system is unfair, but because they simply didn't know what to claim, how to claim it, or when to make the right moves. Well, not this year. Today, 5 practical, legally sound strategies are laid out that can make a real difference to what lands back in a bank account this tax season. These aren't loopholes or gray area tricks. These are legitimate, ATO-sanctioned approaches that smart Australians have been using for years. And if even 1 or 2 of these apply to a specific situation, the result could be genuinely life-changing for a refund, a tax bill, or a long-term wealth-building strategy. Let's get into it. Number 1, claim every work-related deduction entitled to. And this one sounds obvious, but the data tells a different story. Millions of Australians underclaim work-related expenses every single year, either because they don't know the full list, they can't find their receipts, or they assume the ATO will flag it. None of those are good reasons to leave money behind. Here's the golden rule, straight from the ATO. To claim a deduction, the expense must have been spent by the individual, not reimbursed by an employer. It must directly relate to earning income, and there must be a record to prove it. 3 rules, that's it. So what can actually be claimed? Vehicle and travel expenses are a big one. If driving between work sites, visiting clients, or traveling for work purposes, not just the regular commute from home to the office, those kilometers count. Logbook records or the ATO cents per kilometer method can both be used, depending on which produces the better outcome. Home office expenses are another major category, and since the shift toward hybrid and remote work, this has become relevant for more Australians than ever before. There are 2 methods to calculate this: the fixed rate method and the actual cost method. Under the fixed rate method, currently set at 70 cents per hour worked from home, a simpler calculation is available covering electricity, internet, and other running costs. The actual cost method requires more detailed records, but can deliver a larger deduction if usage is high. Tools, equipment, and technology used for work are also deductible. Think laptops, software subscriptions, printers, phones, and even protective clothing or uniforms specific to an occupation. For items costing $300 or less, an immediate full deduction can be claimed. Items above that threshold are depreciated over their effective life. Self-education expenses are one of the most consistently overlooked categories. If a course, workshop, conference, or professional subscription directly relates to current employment and helps maintain or improve specific skills, it's deductible. That includes membership fees for professional associations, technical journals, and licensing renewal costs. Now, the $300 rule. Many people have heard that expenses under $300 can be claimed without receipts. That's technically true for the substantiation exemption, but here's what must be understood. The expense still must have been genuinely incurred, and there must be the ability to explain how it was calculated. The ATO is not a wish-granting machine. Evidence should still be kept. Using the ATO's My Deductions app on a phone is one of the easiest ways to track receipts and log work expenses throughout the year, so there's no frantic searching when July rolls around. One important note: a proposed standard deduction of up to $1,000 for work-related expenses has been announced for the 2026-27 financial year, but it does not apply to the current 2025-26 return. Normal itemized deduction rules still apply this tax time, so make the most of every legitimate claim. Number 2, have a smart capital gains tax strategy. And this one is specifically for anyone who has sold shares, property, crypto, or other investment assets during the financial year. In Australia, capital gains tax, or CGT, is not a separate tax. It's added to assessable income in the year the asset was sold and taxed at the marginal rate. But there are several legal strategies that can dramatically reduce the bill. The most powerful one is the 12-month rule. If an asset is held for more than 12 months before selling, a 50% CGT discount automatically applies as an individual taxpayer. That means only half the capital gain is added to taxable income. For a $100,000 gain, that discount alone saves a person on a 37% marginal rate approximately $18,500 in tax. That's not a small number. The second strategy is offsetting losses against gains. If some investments went backwards this year, those capital losses can be used to offset capital gains, reducing the overall taxable gain. Capital losses can't be offset against regular income, but they can be carried forward to future years if they're not used in full this financial year. The third lever is timing. Because CGT is assessed in the financial year the contract is signed, not when settlement occurs, there is sometimes a window to time asset sales strategically. Selling just after 30 June defers the liability by 12 months, which can be a significant cash flow advantage. There is a critical warning here, however: wash sales. This is where an asset is sold for the purpose of crystallizing a loss, and then the same or substantially identical asset is repurchased shortly after. The ATO has made clear it views this as a scheme to avoid tax, and it can disallow the loss. The intent matters. Genuine investment decisions are different from manufactured transactions designed purely to reduce a tax bill. It's also worth noting that the 2026-27 federal budget announced proposed changes to the CGT discount for certain assets, particularly established residential property purchased after budget night. For existing investment property owners, those changes don't apply yet. But it's worth speaking with a tax professional to understand how future policy shifts might affect a specific portfolio. Number 3. Boost super with salary sacrifice. And this strategy is genuinely underutilized, especially by people in the middle income brackets who feel like super contributions are just something that happens automatically in the background. Here's how salary sacrifice works. A pre-tax salary amount is directed into the superannuation fund instead of taking it as income. That contribution is taxed at just 15% inside the superfund, compared to the marginal tax rate, which can be 32.5%, 37%, or even 45% for high earners. The difference between those two rates is the tax saving. For the 2025-26 financial year, the concessional contributions cap, which covers employer contributions and any salary sacrifice, sits at $30,000. That's the ceiling before additional tax consequences apply. From 1st July 2026, that cap indexes up to $32,500, reflecting wage growth. But for the current tax year, the relevant cap is $30,000. Here's a real example of what the numbers look like. Say someone earns $100,000 a year and their employer pays the 12% superannuation guarantee, which is about $12,000. That means there's room to salary sacrifice an additional $18,000 before hitting the concessional cap. That $18,000 is taxed at 15% inside super, rather than at the 37% marginal rate. The effective saving? Around $3,960 in tax, just from choosing to route that money differently. There is an important caveat here. Super is locked away until preservation age, currently 60 for most Australians, so this isn't a strategy for someone who needs short-term access to those funds. It's a long-term wealth-building move, and it works best for people with a stable income and decades left to let that money compound inside a tax-advantaged environment. Also worth exploring, the carry-forward rule. If the concessional cap hasn't been fully used in previous years and the total super balance is under $500,000, it may be possible to carry forward unused amounts from up to 5 prior years and make a larger concessional contribution in a single year. This can be a powerful tool for people who had career breaks, part-time periods, or simply didn't prioritize super top-ups earlier. Number 4, maximize investment property deductions. And for the many Australians who own rental properties, this is one of the most significant tax optimization areas available, especially for the current 2025-26 financial year, which sits before the proposed negative gearing changes take full effect. Under the current rules, which apply to tax time 2026, if an investment property runs at a loss, that loss can be deducted against all other taxable income, including wages and salary. This is negative gearing, and it remains fully available for all properties held before budget night on 12 May 2026. The full range of deductible expenses for investment property owners includes interest charged on investment loans, council rates, water rates, property management fees, insurance premiums, advertising for tenants, repairs and maintenance, and that last one requires a careful distinction. Repairs, meaning restoring something to its original condition, are generally deductible in the same year. Improvements that increase the value of the property are capital in nature and must be depreciated over time. Depreciation is its own powerful category. 2 types of depreciation can be claimed: Division 43, which covers the building itself at 2.5% per year over 40 years for eligible properties, and Division 40, which covers plant and equipment, things like air conditioners, carpets, ovens, hot water systems, and window coverings. Getting a professional tax depreciation schedule from a quantity surveyor is one of the highest return investments a property owner can make. It can uncover thousands of dollars in deductions that would otherwise go unclaimed. Now, an important update. The 2026-27 federal budget proposed significant changes to negative gearing for established residential properties purchased at budget night onwards. From 1 July 2027, investors who buy established residential properties after 12 May 2026 will no longer be able to deduct net rental losses against salary or wage income. Those losses will be quarantined and can only offset future rental income or capital gains from residential properties. But here's the key. Properties already held before that announcement are grandfathered. Nothing changes for them. And new builds are exempt from the restrictions, meaning the tax incentives for building new residential properties remain fully intact. The message for current property investors is clear. Get that depreciation schedule done. Ensure every eligible expense is claimed for the 2025-26 year, and speak with a property-savvy accountant before making decisions about the portfolio. Number 5, use a tax accountant. And yes, their fees are tax deductible. This tip often gets a polite nod and then gets skipped in favor of lodging online. But the reality is that a good tax accountant doesn't just fill in boxes, they find money. Tax law in Australia is genuinely complex, and it changes every year. The 2026 tax landscape includes updated work-from-home rules, the negative gearing reforms, upcoming changes to the standard deduction, CGT discount proposals, supercap indexation, and an increasing level of ATO data matching that makes accuracy more important than ever. The ATO is now cross-referencing data from banks, employers, private health funds, and digital platforms. Mistakes don't just cost a refund, they can trigger audits. A qualified tax accountant brings current year knowledge, personalized strategy, and importantly, accountability. They know which deductions apply to a specific occupation, how to structure an investment property claim, and how to navigate complex situations involving multiple income streams, shares, crypto, small business income, or foreign earnings. The generic online calculators and autofill functions are not equipped to do any of that. The fee itself, whether paid to a registered tax agent for preparing and lodging the return, is deductible in the following financial year. So the cost of a tax accountant this year is claimed back next year. That is a built-in discount on professional advice. When is it especially worth it? For property investors, the value is clear. The right accountant will often find depreciation deductions and structuring opportunities worth many times their fee. For business owners, the complexity of mixing business and personal income, GST, and superannuation makes professional help nearly essential. For people with share portfolios, crypto assets, or foreign income, the nuances of CGT, wash sale rules, and foreign income offsets are genuinely tricky territory to navigate alone.